afternoon, friends. Welcome to one more session of a webinar. This time the topic is on futures and options. And who better to talk about futures and options than VK Sharma. Sharma ji, welcome to this webinar.
Thank you.
Mr. Sharma is an expert on FNO. He has been appearing on various TV channels, sharing his views about trading strategies in FNO. He has been lecturing, giving lectures, talks, etc. Across the country, raising awareness about futures and options as a trading strategy. So now over to you, Mr. Sharma. Basically, we will try and address people who so far have not done any trades in FNO, and also people who have not done the right trades in FNO. Over to you, last.
Okay, thank you. Deepak, I was just speaking to our dealers here, and the basic problems that they faced was twofold. One is some of the people do not keep any stop losses, so they tend to make a lot of losses. And there are ones who do put stop losses. Some of them find that these stop losses get triggered every now and then. So is there a way out? And there are many other people who want to use derivatives to buy the stock at their own price. Is it possible to do it? While it is perfectly possible, and I'll explain it to you in detail, but considering the fact that many of you may be beginners here, so I would like the rest of you who are well entrenched into options to just keep a low profile and allow those other ones who do not know maybe to answer questions first, to ask questions first. So I think, Deepak, it will be quite in place to tell them what is the stop loss first. Suppose you have bought a stock at 70 rupees and you want, or you have been given advice that the stock will touch 75 and you will make 5 rupees on this. So while you would make 5 rupees, it is important to understand that you need to protect your downside. So you might tell the dealer that I do not want to lose more than 1 rupee in this deal. So the dealer will put a stop loss at 69, 1 rupee lower than the price at which you bought. So here the ratio is pretty good. You could lose 1 rupee, but if the trade goes your way, you could even win 5 rupees. So basically, when you put a stop loss, you stop your losses from getting interest, getting longer. So while you extend your gains, you put a stop loss to your losses. Now those people whose stop losses get triggered every now and then, because markets are volatile, and therefore suppose I bought the stock first time at 70 rupees and then I feel that I'm holding it, the stock goes to 72, then it tumbles to 68. I lost 1 rupee because 69 my stop loss got triggered. I do it once more, again I lose. So is there a way out in which the investor can comfortably, or the trader can comfortably sit and still make some money in case the trade goes his way, but also does not lose much? So when you buy a call option, essentially when you buy a call option, you are buying the right to own the stock, but your loss is limited.
Yeah, so essentially this is a way to manage your wealth or protect your wealth. Rather than allowing it to sort of erode in a matter of few trades, you can sort of protect the downsides. Is it right?
Yeah, anyway. So essentially, the reason I want to, one point that I want to make is that if you have just traded once, the moment your stop loss gets triggered, you're out of the market. But if you, in turn of that, if you bought an option, buying an option means, for instance, the 70 rupees, you bought a call option at around 2 rupees, for instance. So 2 rupees is your stop loss, and those trades will end at the last Thursday of the month, and you pay just 2 rupees, I pay just 2 rupees as a premium, and I can sit tight. And in case the stock falls to a level of 60 rupees in the settlement at the end, so the stock price gets settled at the trading which happens in the last half an hour, and the trade stock closes at 60 rupees. So somebody in the cash market would have lost 10 rupees, but since I bought a call option, I will only lose 2 rupees, the premium that I paid. So when I buy a call option, my loss is limited to just 2, irrespective of where the stock goes. Now let's take the other way around. When the stock prices go up, give me a figure.
Yeah, the same 60 rupees price and
the 70 rupees price and
70 rupees
over,
price.
let's say what
78.
price? 78.
Right.
So the price goes to 78. I have bought it at 70. I get 8 rupees, 78 rupees. 8 rupees is the notional profit. 2 rupees I have paid a cost. So my cost comes to just 2 rupees and my incoming inflow is around 8 rupees. My net profit is around 6 rupees in this deal. Okay?
Okay, so now people at times wonder as to which is the right strike price to buy and when is a good time to buy. So can you guide them about this?
Okay. I think to begin with, the people who are beginning just taking their first steps into derivatives, they'll do well to enter or try derivatives in the last week of the settlement, as we are in now. So if you were to look at and trade then what happens? The premium prices are low, and the chances of making good money are also higher in the last 1 week if your trades go right. So for that instance, so I think it makes all the more sense to give you a perspective that if you buy a call option, it is almost a season ticket for the entire month. So if you're buying the last week, for the last whole of the week till about last Thursday of the month, it's a season ticket. Even if the stock goes to, in between goes to 60, but comes back and closes at 68, you'll make 8 rupees. Had you just traded in putting a stop loss, you would have been out of the market, you'd lost 2 rupees and you lost your 1 rupee, and you would not have bought the stock all over again. So I think call option buying is a great activity for frequent traders. Those who do not want to trade need not trade, but those who are trading, I think trading through a call option, at least to begin with in the last 1 week of the settlement, will fetch you good returns, and the current week or the next week that you can just try it out in the way that you would want.
So is it right to say that one should be buying out of the money calls where the premiums are very small so that you can afford to lose them if the trade goes against you?
Yes, but here we are introducing jargon here. So I think the people may not be aware what is out of the money. So let me just put it this way, that the stock is quoting at around 70, then the price which is above that, if you are buying a strike price which is above the current price, is out of the money. And normally the chances of that event happening are less, but if that happens, then you will make good amount of money.
Correct. And one need not keep any stop losses in the option, right? Or would you suggest that also?
Especially when you are buying a call option in the beginning of the month, then of course you need to keep a stop loss. Now we are choosing options instead of trading in the stock, and in call option I am also suggesting that if the time period is more, say around 2 weeks or 3 weeks, it is ideal to put a stop loss there also. How does it work? For instance, let's take the same price of 70 rupees a stock, and now we are buying in the first week of the month, and the settlement is still some 30 days away. So the premium price would be high. So the question is, what should be the premium price? The premium that you're paying, for instance, is a function of 2 things. One is, what is the likelihood of the stock going up or down? So somebody who has if I'm buying call option, I'm not taking any risk. So it is an insurance premium. So insurance premium is a part of this premium that I pay, and also the fact that since I'm only paying 2 rupees for that share per share, so I'm not paying the entire 70 rupees. And if I were trading in futures, I would have been paying 25%. So instead of that, I'm just paying 2 rupees, and therefore, and if the amount of period the settlement is away some around, let's say around 30 days, then obviously the premium would be high because the interest component would be high. So the premium that one pays for a call option is a function of two things: is the risk premium I'm paying because I don't want to take losses, somebody else is taking that loss, and second is I'm paying only 2 rupees instead of 70, the interest. So as time passes, as you go near to the expiry, the premium component will start decaying, the interest component will start decaying, and the risk premium will always be there, but it will be very less as compared to when you are at the last day. In the beginning it's very high.
Now, sometimes traders are tempted to sell options. Do you recommend that at all?
Okay, now friends, forgive me for introducing a concept here at this point of time. I think the next session that we'll do will begin afresh from call options, and then we'll go buy a call option and selling a call option. These things we'll address in that, and then we'll look at put options. But just to, in order to address Deepak's suggestion that can an investor today use options to buy a particular stock at his price? Let me give you an example. Let me give you an example of Coal India, for instance. Now, Coal India, as our team had come out with a report, and at today's price of 288 when it is closed, the yield is 9.5%.
Dividend.
Deepak is also in your dividend list.
Yeah.
So this particular stock, if you look at, it gives you a dividend yield of 9.5%. But the chances are that will the company be able to give you this kind of dividend this year also, considering the last result? Now there are many things. The last results were a function of the fact that those expenses are not going to be repeated in next year, so next quarter, so the profits will be higher. But nevertheless, 27.4 rupees is the dividend which the company had paid last year. But considering the fact that the government had stressed upon the PSUs to actually go out and give higher dividends, let me go back to the year before that. That was just 20 rupees. So if you pay 20 rupees at 20 rupees on let's say a price of 290, will come to around how much, Deepak?
It's about 6.9%.
So even if it pays 20 rupees the year before last which was given, the yield will still be 6.9%. Compare that to a 7% FD. Considering that you are in a 30% tax bracket, your dividend will be around 4.9. The interest that you will get, real sense after deducting tax, will be 4.9. So this compares very favorably with the yield of 6.9 of Coal India, because the dividend is tax free in the hands of the shareholder.
Correct.
Now, can an investor improve his yield by virtue of derivatives? Very interesting proposition. This is something which I told on CNBC in the morning also. Now, Coal India, the put, if somebody sells a put of Coal India which quotes at 288 cash market, 290 was the strike price at which the option quotes at 7 rupees. So if you are selling 290 put option, you get 7 rupees. So essentially what I am saying is that you sell the put option of Coal India at 7 rupees and wait for the settlement. This for the next month. This for the January series. By the end of Jan, in case Coal India comes to around 280 rupees, you are obliged to buy. You should buy. Then we will, in the cash market, will go out and buy Coal India on the last day of the settlement at 280 rupees. But my cost will still be. My cost will be what? My cost will be
minus 7.
Yeah, but I've written that 290 rupees put I've written. So my cost will be 290 minus 7 rupees. My cost will be 283. So I'm buying so I've ended up buying Coal India at 290, but I've got 7 rupees as premium now, and then Even if the company pays 20 rupees, my yield will be 20 plus 7 is equal to 27. I will increase it. Now in case Coal India doesn't come to 290, it doesn't close below that, it closes above that, I'm not obliged to buy, but I can very well keep those 7 rupees with me.
Correct.
And next month, in case the price goes up, I can write the higher strike price, and if that strike price is 300, if I get a premium around 5, I write that put. Again, if the price closes above 300, I get to keep my 5 rupees, and in case it closes below 300, I'll get an opportunity to buy that stock at 300 rupees. So in any case, you can use derivatives, but mind you, when you are writing or selling options, it is a very dangerous thing if the intention is not to buy. But if the intention is to buy, this is a fantastic opportunity that all of us can use it effectively to bring down the cost of a purchase and also to earn let's say income by the virtue of the fact that if I am making a, let's say I'm saying that I'll buy at 290 and the price, it's a bad market, the price goes up again and doesn't come down, I'll be rewarded by those 7 rupees. So no issues at all. Puts can effectively be sold by those people who have the desire and the ability to take delivery of the stock for which the put has been written.
Right. Now, lot of people have a lot of stocks with them. So, can they sort of earn some money by way of selling option or buying options against whatever they are holding?
Okay. Let's say to stay with the Coal India option.
Yeah.
Now let's say while I don't have, so I'm writing a put option. But suppose Deepak, you have Coal India and you got an allotment at 245 in the initial price, and you are gung-ho on, you're not so much gung-ho on Coal India now at this point of time, and you say, okay, at 310 rupees, if it goes above that, I am a seller. So I think I'll look at and ask my dealer, what is the premium of call premium at 310, and he says if the price is around 3 rupees. So that means Deepak will get 3 rupees by writing the virtue of the call of 310 rupees strike price. He'll get 3 rupees, and in case the prices tumbles, price doesn't go up, it doesn't go up beyond 310, he gets to keep those 3 rupees. Let's take another example. It tumbles to 280. He still gets to take his 3 rupees. If the price goes to 320, so then Deepak will sell his stock on the last day of the trading settlement at cash market price is 320. He'll sell his stock that he has at 320 rupees, and he will lose 10 rupees in the derivative for which the call has been written. 10 rupees is the cost price difference he'll have to pay, because he in the cash settled at 320 and 310 the call he had written. The fact that 3 rupees was the premium that he had received, so actually he will lose 7 rupees on that particular cost, particular derivative deal. But his realization ultimately is what? Whatever 310 rupees he wanted to sell, effectively he has been able to sell his Coal India at 310 rupees. Because although he has sold in at 20 rupees, 320 rupees price, but the 7 rupees premium that he gets, the 3 rupees premium he got, and 7 rupees you lost. So overall your cost is still, you ended up selling Coal India at 313. So even investors who want to use derivatives to sell their stock at their price can use it effectively. And if Deepak continues to write his call options at 300 strike price and 320 rupees strike price, he'll continue to gain his premium, and the premium he gains will bring his cost of his original stock down every month. If he sells, he'll be selling it at his price. So investors who want to buy a stock at their price should write put options, and investors who hold stocks and want to sell their stocks at their price can write call options. So when you're writing call option, you need to have a stock. When you're writing puts, you need to have the requisite cash. If you're doing this, then it's not risky. But if you're doing it otherwise, which is risky and fraught with danger, which we do not subscribe, which we do not recommend at all. If at all you have to take risk in terms of buying a call option, or when you want to protect your portfolio, buying a put option in that particular stock.
So coming to protecting your portfolio, people also in such uncertain times want to protect their downside or hedge their portfolio. So how can they do that by using option strategies?
Okay, very interesting question. And Deepak, this is the way in which derivatives can be effectively used. See, derivatives are available only in a handful of stocks. Not more than 170 odd stocks are traded in derivatives. So you can effectively buy a put in your stock concerned if it is traded in the derivative segment. If it is not traded in the derivative segment, you can't buy. So other option left to you is to buy a put in the Nifty. Now it's not necessary that the Nifty falls 3%, the index of your particular stock will also fall 3%. No, it may fall more. So if you bought a put in the Nifty, it will only protect you to the extent of 3%, and if your stock has fallen more than that, that's your loss. So effectively, there are strategies which can be evolved, and we'll just tell you example about strategy that we gave in times of Brexit. Deepak, if you remember, we had said that, and we were wrong. We said that although we do not expect that Brexit will happen, but we will, since it is a binary event, we would want you to be protected, and therefore to the extent of 30% of your portfolio you can buy puts, but not in your own stock, but in Tata Motors. Now this might seem quite strange, because we are seeing that despite the risk of Brexit being there, Tata Motors were continuing to do well, and should the Brexit vote win, in that case Tata Motors was supposed to fall more. So that strategy really paid out, and while the Nifty fell 3.5%, Tata Motors fell 13.5%. So you, in terms of option, the pricing was different, but you ended up making 5 times the money by buying Tata Motors put instead of the Nifty. This is not necessarily every time it will happen. You should use and consult us in terms of buying a puts whenever you want, or protecting your portfolio. But mind you, portfolio protection comes at a cost. You cannot protect your portfolio all the time, neither it is desirable, because markets will give you risks, markets will give you jitters. If you are just going to buy puts every time that you feel jittery, I think you would have lost a lot amount of your premium. So our own sense is that derivatives should only be used selectively and when you need, but those who are traders, if they trade through the option route, the chances of making losses are pretty less.
Yeah, I think that was a very nice overview of how we can use options for various strategies. Now, shall we go to take in some questions?
Yeah, please.
Now, there are some stock-specific queries which I don't think this is the right forum, right?
No, we are not. We're just educating them. So maybe we can give a market view together after this, so that both of us can give.
How to choose an option to trade? Now, this is a question by Sanjay Arora of Delhi. So, can we answer this?
Yeah. The option, first and foremost, you should not choose merely an option. In fact, you should not choose anything. if you think that a particular stock will go up, then you look at the option pricing. If the option pricing, if the stock is good, it will move up, then you look at buying an option, the call option. If you think that a particular stock is wanting to go, is probably going down, then you buy a put option there. So you don't choose based upon, you first choose the direction. So if you are sure of the direction, strategies can be made. If you are sure of the direction, premium can be bought. Even if the pricing is high, no matter, you can still buy. So obviously the premium will be a function which you have to pay, but also our investors and traders will also like to monitor. So people who are trading in cash market, when they go to derivatives, they face a small problem called the market lot.
Yeah.
So this is while a small problem to some, it is a big problem to understand that while a small investor can buy one share of any particular stock, 2 shares of his liking, he can sell whatever he wants. But the fact is, when you go to options, you have to do it in a particular manner. So like for instance, the Coal India we are speaking about has a market lot of 1,700 shares. So unless you are willing to buy 1,700 stocks at one time, Coal India writing put option is not for you. So even if it costs 2 rupees, suppose you want to buy a call option there, and it's 2 rupees, you have to multiply 1,700 into 2, so 3,400 rupees is the premium that you need to pay. So this you need to consider. But more important than the pricing, important is the fact is that the direction should be clear. If the direction is clear, you can even buy a high price premium.
Right. Now, strategy for our profitable options that we have already covered. Pramod from Bangalore has this question. I think we have covered that adequately. There are some questions on demonetization impact and all. This is not the right forum, so we will not take those questions. What is the safe derivative option strategy in any market conditions? Now, Mr. Sunil Kirulkar.
Okay, Mr. Sunil. First and foremost, strategies can be made, but first and foremost, you need to know the direction. If you know the direction, you can effectively go out and profit from it. Strategy will be made. So, knowing the direction comes first. So, if you think, let me give an example. If you think that Coal India, from a price of 288, it is going to go at a price of not, maybe it can go to 310, but not beyond that. In that case, if this is the scenario, you can buy the 290 call at around, kitna hoga? Let's say 290 put was 10 rupees, 290 call maybe around 6 rupees. So 6 rupees you buy, so that means you're paying 6 rupees, and you also know that it is not going to go beyond 310, so you can sell a 310 call option, and let's say the price at that time is 3 rupees. So you bring down your cost of Coal India call buying from 6 to 3. 6 rupees you have paid, and 3 rupees by virtue of selling that option you have bought. Now here you are not taking any risk, because your risk is limited to the premium you are paying. Sorry. So I think let's celebrate the Christmas with them, because this is a
carol.
This is a carol which is going on. So what do we do?
Yeah.
This will continue for a while.
Now we'll continue. We'll talk a little louder, I suppose.
Okay. So let's keep it nearer to us. So Deepak, what happens? Where were we?
3 rupees,
Yeah,
6 rupees.
So, but wherever you feel, if you feel that Coal India will run away, and Coal India can possibly cross a level of 350, if this is your thinking, then I would suggest that you buy the 310 call at 3 rupees and not the 290. So, and keep your options open. So in case So we'll have to close it.
No, we'll take a small break. Let the people also.
Okay, sir.
Yeah, welcome back, friends. Sorry for the small interruption. Yeah, now one more question which I think we can take is our Rajesh from Trichy has asked for weekly bank nifty advice.
Okay.
So it's on.
Yeah, friends, we have seen that the weekly bank nifty has really caught up, and it has caught the fancy of the traders, sellers, traders, not investors. So I think this is more volatile, and therefore people who want more bang for their buck, and also obviously you lose also, but you're going through the options route and probably you wanting to put a stop loss to it. I think this is ideal. But again, the same thing. In order to ensure that the trade that you do is profitable, you ought to do it only when you are sure of the direction. So please do it only when you know which direction it is headed, or if there is a bank nifty call by the research departments that we have. So best idea would be to follow them, and if you have the ability to make your own calls, then obviously that's the best thing that one can do. But you're right in the sense that since this is volatile and very liquid, so I think trading here with the option route effectively pays out.
And because it is for 1 week, I think the premiums are also small,
Yeah,
rather than for 1 month.
Yeah.
So that is one more advantage.
Yes, that's the advantage. But remember that the market lot, especially, is large.
Right. So now you talked about picking your stocks rightly. Now one of the participants, Sachin Oak from Pune, has complimented you. He says, I follow your calls every Friday on CNBC TV18 and am really amazed by your picking. Out of so many stocks for which we know the direction, especially in a falling or rising market, how do you pick the perfect 2 or 3?
Thank you, gentlemen, for these kind words. But if you had traded today, most of our calls went wrong. But if you did all the calls, you would be sitting on a still good profit, because most of the trades had a stop loss. But at the end of the day, the gains that you made in divvies would have nullified the other losses. Nevertheless, but the fact is, the question is how to choose.
How do you choose those 2 or 3 stocks?
So we look at some of the things, and the things are that we look at an entire international market, the gamut, what's happening, what are the expectations, and for instance, the US markets may have closed up, okay, but you know that China has done a currency devaluation, obviously will be more impacted by that, and therefore, so we look at the international markets, what has happened where, what is the derivatives positions here, how are the stocks technically placed, and if the stock has gone down after a bad set of results, because apparently the numbers were bad, but inside if you look at the numbers are good, I think we'll choose that stock for a buy at dips. So effectively you look at many other things, not only derivatives, what is the option, how much is the OI built up, to what extent the stock has gone up, but all things put together. This is something that we can only experience over a period of time, and when you are discussing a particular stock on a given day, when you know the situation, at that time it can be better addressed. Next time when we speak, I think I'll also give you a call which you can trade the next day. So that will effectively be on that day. So that we'll discuss and we'll give you the reasons. Obviously, we'd like to give you that call with a stop loss, of course, so that you do not lose money. Because when you're trading, obviously, loss is as much a part of your, let's say, fate as much as a profit. So we need to do trade safely.
That should be very interesting. I think people will look forward to that.
That will be a great idea, Deepak.
Right. Now we'll take one last question. I think we should take.
Yeah, please.
Mr. Vikram Parekh from Mumbai, he is asking how to choose strike price in the beginning, middle and end of the month. Okay.
Why don't you answer this question, Deepak?
No, you are the expert.
No, I'm not an expert. I'm just a student of the capital markets, and we all are. It just happens to be that we have had this opportunity of being on air and all that. But let me tell you that when you are entering a trading strategy in the beginning of the month when you want to choose a strike price, let me approach it from a point of view of the user. For instance, it's the beginning of a new series. After next Thursday of the month, what should you do on Friday next? Okay, what should you do will be a function of what do you want to do. Do you have a stock on which you want to write a call? Obviously, when you write a call, that strike price at which you write a call has to be in a profit. Otherwise, there is no use selling that. So that decides if you are doing it from an investor's perspective. Another investor perspective, if you are wanting to write a put, obviously it will have to be at a price at which you want to buy, and it should be lower than this. So if you are wanting to invest, or if you are wanting to write a call because you have a stock, it is answered. Then it is a function of whether you want to buy a call or a put. Okay. Then the direction comes in. If you think that if you're going to go on that particular stock and the quantum of jump is going to be high, remember it's the beginning of the month and you're doing it, the chances of premium decay happening is pretty high. So I do not, unless you are writing a call on a stock that you have and at a price that you are comfortable with, I do not recommending buying call options in the beginning, because there is a good amount of delay. But buying call options in the middle of the series and more towards back end of the series is highly profitable. So that obviously will come from a function of what stocks depending upon. So I'll just give you one more let's say direction here, that for call option traders it is best to trade in the second part of the month, because especially when you know that, for instance, a stock you've seen which is continuously going down for 5 days, technically it has gone down and the stock has tumbled, and the 6th day you find that the stock price is now moved up above the 5-day moving average or whatever. So you're using technicals to decide on your derivatives. At that point of time, buying a slightly even in the money call and writing a higher call would be a good idea. But if you're in the fag end of the settlement, then merely buying a call at the next strike price would be good enough, which is higher than the current market price. So I think this should basically give you an idea. Ultimately, it comes within that what is your gut saying a lot of time. But before listening to your gut, if you do your homework, I think your gut will also direct you rightly.
Yeah, one last question if I take. Abhishek Malia from Mumbai is asking that, do you become eligible for dividend if you have bought derivatives?
See, unless the dividend is more than 10% of the strike price, it won't be adjusted.
We have covered most of the relevant questions. I think thanks a lot, Sharma ji, for this enlightening talk. I think a lot of our viewers would have benefited out of it, and as he has said, we will do further series on this F&O topic going forward for people who want to sort of study more about F&O.
Next time, friends, we'll also have these slides ready so that you can keep on seeing on the side of your screen the points we are talking about. So that will make it slightly easier and a more of classroom-like situation when you are really wanting to look at stocks and studying these derivatives.
That would be great, I think.
Yeah, we'll just try that. We'll do a dry run now. And thank you, friends. Wish you a Merry Christmas and a very Happy New Year. Thank you for all your time and waiting for those 5 odd minutes when we had the interruption.
Thank you so much.